Hello, everyone, and thank you for taking the time to join us here today. My name is Jeff Weiss, and I welcome you to today's webinar, PP2 and ERC, What You Need to Know, co-hosted by CMIC and Marcum. CMIC is a leader in construction ERP software with hundreds of customers throughout North America and expanding global presence. CMIC delivers the most comprehensive and advanced enterprise and field operation solutions, purpose-built for construction companies. CMIC's powerful software transforms how firms optimize productivity, minimize risk, and drive growth by planning and managing all financials, projects, resources, and content assets, all from a single database platform. Marcum is a top-ranked national accounting and advisory services firm dedicated to helping companies achieve their goals. Marcum's construction services group is dedicated to assisting contractors with personalized and attentive service, strong technical expertise, and uncompromising integrity. Regulations related to the construction industry can be complex, making compliance with these laws an ongoing challenge. Today, Marcum's thought leaders will be sharing great insight into the PPT and ERC programs. Moderating this webinar will be Joseph Natarelli. Joe is the national leader of Marcum's Construction Industry Practice Group. With more than 30 years of accounting and consulting expertise, Joe is an active member of the construction industry. He has been interviewed by a number of prestigious media outlets, providing insights and guidance on the ever-evolving construction industry landscape. His current focus has been on helping clients navigate the COVID-19 pandemic to support and preserve their businesses. We have a lot of great content to cover in this session, which will also be recorded. And with that, I'd like to introduce to you Joe Natarelli, who will be moderating this webinar.
Thank you, Jeff, and welcome everyone. My name is Joe Natarelli. I'm Marcum's National Construction Services Leader. I will be moderating today's panel. We're pleased to team up with CMIC today to provide you with the latest information on the Paycheck Protection Program and Employee Retention Tax Credit. Joining me on the panel today is Mike Maximiu, tax partner and member of Marcum's SBA Task Force, Jim Miller, assurance leader in Marcum's Construction Services Group, and Jeff Weiss, Chief Revenue Officer for CMIC. Just a quick agenda for today. We will cover round 2 of the Paycheck Protection Program, guidance on the Employee Retention Tax Credit, information on tracking and reporting key metrics, and then we'll go into a live Q&A where we'll be answering your questions. This is an open forum. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. And with that, I will turn the session over to Mike Maximiu.
Thanks a lot, Joe. Appreciate it. Good introduction. So the first thing that I'm going to lead off with is these slides have a lot of content on them. These are for your reference to go through as we're speaking and giving you an overview of everything. I'm not just going to read the slides off. That's not really interactive, but I want you to have all the data so that if you look back on a question you might have, you can reference the slides. You can reach out to us afterward with any questions you have. So the first thing up, PPP loan expenses. Great news. They're fully deductible on a 2020 tax return now. The original IRS position was overridden by the congressional actions that were passed on December 27th. So that's really good. It does have a couple of kind of maybe unintended consequences if you're a pass-through entity like an S Corp or a partnership. And that has to do with timing of the expenses versus timing of the loan forgiveness. The loan forgiveness is tax exempt income, but for tax, it's not tax exempt income until the loan is forgiven. Even if you take a financial statement position where you've taken it into revenue, that's different than the tax rule. So because you're deducting the expenses in 2020, if you don't get forgiveness until 2021, you have a timing issue there. So Just watch out for that if you happen to be a pass-through entity, because it could matter. Now we're going to go into the eligible expenses because they've changed a little bit. The new law on the 27th added some additional costs that can go in. The payroll costs remained relatively unchanged. It's wages, health insurance, retirement benefits, and employer-paid state taxes. The primary change here was that we got more guidance around what you can include in employee health costs. We now know for sure it includes healthcare, dental, vision, life, and disability plans. And this is the employer-paid portion. So if you have an entirely employee-funded health plan, you won't get any additions here because that's already included in their wages. But anything that the company contributes would count here. Here's where we had a lot of changes, the non-payroll costs. This category can include up to 40% of the total loan forgiveness amount that you're using. That's an important statistic to remember because we're going to go into an example later on of how you can have a payroll protection forgiveness and an employer retention credit that covers the same period, and you can't duplicate costs. So if you're in a situation where you're trying to pick and choose which wages, these costs now become that much more important because you can fill up that PPP bucket with non-wages, which can free some expenses up for ERC. We'll see that in action in an example a little bit later on. The expenses that remain are rent and lease payments in place prior to February 15th, mortgage interest for mortgages in place prior to February 15th, and utilities that you've already had on February 15th and have continued to go on. We did get a definition of transportation. Originally, we thought it might be actually moving around in vehicles, whether it's fuel, whether it's other kind of costs like that. It turns out it's not. What they mean by transportation is the cost to get the electricity from the electricity plant to your place of business. If that's a separately stated item on your bill, that transportation counts as utility. That's what it means. So it's not fuel in trucks or anything. So just keep that in mind too. The four new costs are the one on the slides that start with covered. So we have covered operations costs, covered property damage, covered supplier, and covered worker protection costs. We don't have any guidance beyond what's on this screen for what these entail. The biggest one that I get questions on is the covered supplier cost, because it sounds like it includes almost anything you had a contract for in place before you get your loan and you pay during your loan period. We're expecting some guidance to kind of narrow that down a bit. But until we do, just like with PPP1, track whatever you think might be relevant to your business and wait for guidance to tell you that you can't have it. This way you're accumulating these costs as your period goes on. Around the covered worker protection costs, we have some more rules and items that can go into this, which we put on this slide because we got a lot of examples in the law versus specific you can and can't to do this. What I found interesting was if you installed a drive-through window, that could count, which is weird because normally we can't include capital type items when we're using credits. It was a big change from other tax rules that we're accustomed to using. But having that in there as an example, it means if you did something similar in your business to outfit it, to retrofit it, to do something that mattered to you, it could count as a covered worker protection cost. Think about how your sites might have had to be modified or anything of that nature that you wouldn't normally do. It might be able to fit into this category if its purpose was to protect your employees or your customers or other workers on the site. All right, so into the PPP2 second draws. So this is assuming you've already had a first draw loan because that's one of the requirements in order to get a second draw loan. You've got to apply by the end of March. So we've got about 6 weeks left to do that. So if you haven't already applied, you still have some time. At last check, through various internet sources, there's still plenty of money around. We didn't go through all of the money as quickly as we did the first round of the first PPP, where it was gone in about 2 weeks. There's still, the last time I checked, over $100 billion available. So not a rush, other than we've only got 6 weeks left. There's two primary tests that you have to pass in order to apply for PPP2, in addition to already having a PPP1. One is you need 300 or fewer employees. And the other is you need a 25% decline in gross receipts in a calendar quarter of 2020 compared to that same calendar quarter in 2019. One of the questions we get really often in the construction industry is, how do you calculate a decline in gross receipts using percentage completion, using completed contracts, using all the different various accounting methods that you can in construction. And it's one of our Q&As that we're going to get into later on because the answer is really detailed. And if I'm honest, Jim Miller's got a better answer for it than I do because this is what he does. So I'm not going to steal Jim's thunder there. Going back to the 300 employees, the count on this is different than the full-time equivalent test. And what always boggles my mind is how many definitions use similar words but have different meanings in this program. So 300 or fewer employees is calculated the way the SBA tells you to. And that's over the last 12 months before you applied. What was the average number of monthly employees you had for those 12 months? And an employee counts once they get to 40 hours worked in a month, not a week, a month. So on average, 10 hours a week, that employee would count as an employee, whether it's part-time or full-time, they'd be one person for that time period. So how much can you get? It's 2.5 times your average monthly payroll. This calculation did not change other than we have some more healthcare costs that we can include in our overall calculation. You can pick between your 2019 payroll, your 2020 payroll, or the last 12 months. But whichever one of those that you use, you have to be consistent. So theoretically, you can take the exact same numbers you put on your original PPP1 application and use them again for PPP2. Why might this matter? If you had fewer employees or less work in 2020, so your wages were down, you can use the larger 2019 numbers to calculate your loan amount. For anybody who might be going for a loan that's less than $150,000, your application's super simple. You just ask for less than $150,000 based on your payroll costs. You don't have to show the revenue reduction on the application, but you do have to show it on forgiveness. So if you're pretty sure that you met the criteria, that's really good, but just be aware that if you didn't, you're gonna have to repay your loan because you wouldn't have been eligible to take it. Now, for those of you who took a PPP1 draw, but for some reason didn't get all of it, you can go get the rest of it. So let's say you don't qualify for PPP2, whether you have more than 300 employees or you didn't have a revenue reduction. If you're looking back at your PPP1 and you go, oh man, now with these extra healthcare costs, or I didn't include all my retirement contributions, or I didn't know what I could include for S Corps or partners because the rules were all wonky when we were originally going through this in March and April, you can go back and recalculate your maximum loan amount under the old rules. So we have a max loan of 10 million, you only need 500 or fewer employees, you don't need the revenue reduction, you could also meet an alternative size test. So if you didn't get all your money in PPP1, you can go back and get it now. And there's a separate bifurcated amount that's available for that. It's included in the overall 284 billion, but it's got its own little pot and pool there. So if you have any questions on this type of item and how it might apply to you, you can certainly reach out to us or your accountant to help you out with that piece. All right, what else do we need to know about the PPP? We got clarification that your covered period can now be a time between 8 weeks and 24 weeks. The way the rules were written before, a lot of banks interpreted them as one or the other. So if you completed all of your PPP cost in 12 weeks, the bank still made you choose 24. Now you can pick between 8 and 24. This might matter again for your ERC calculation and when you might be eligible. So keep this in mind. The government extended the amount of time that they'll pay other SBA loans that companies may have. So the way that this works is if you had like a 7A loan that you were making payments on, and then because of this law and the CARES Act, you didn't have to make payments, the government making those payments on your behalf gets extended. So you can reduce the amount of your loan on your books. It's tax exempt income. So you don't have to pay any tax on that loan forgiveness either. As we've talked about before, there's a significant interaction of the employee retention tax credit and the PPP wages because you can't use the same dollars for both. We're gonna go through an example of this. I'm excited about it because it shows how you can get full forgiveness and a maximum ERC based on your employee levels. And you'd be surprised how fast this ERC number can get up to big dollars that will really matter. So how does the ERC work? We have 2 different years and 2 different sets of rules. So we're going to start with 2020 first, because all of that data is already fixed. In 2020, you need one of 2 things. A government shutdown order that said that you couldn't work at least partially, if not fully. Think like a restaurant where they can't do all in-service dining, or they're still reduced the amount of capacity they have. That's still a governmental order that exists. So that's the way that it could qualify. I had a different construction client call me up a couple weeks ago. They said they had work in New York. They were shut down for 10 consecutive days when New York just put everything to a standstill. For those 10 days, that construction company counted for ERC. So the wages they paid in those 10 days were eligible, even though they didn't have a revenue reduction. For those 10 days, they had the governmental order, at least partially shutting them down, so they were good. If you don't have a governmental shutdown order, you need a 50% decline in gross receipts comparing a quarter in 2020 to the same quarter in 19. If you do, that opens your window. So now you begin to be eligible for the employee retention credit for that quarter. And you stay eligible until your gross receipts for a quarter in 2020 are under 80% of the same quarter in 2019. So when I first read that, I had a hard time wrapping my brain around it. And then somebody gave me this example. So in quarter two, in 2019, you had $400,000 of gross receipts. And in the same quarter in 2020, you had $180,000. So you're underneath the 50% threshold. All right, good, your window opens. Third quarter, 2019, you had $400,000 of gross receipts. In 2020, you have $300,000. You're at 75% of 2019. Since that's still under 80%, your window remains open for the third quarter. And if in the fourth quarter, you have $400,000 of gross receipts for 20 and 19, your window closes at the end of the fourth quarter. So your wages eligible for the ERC would be the second quarter, third quarter, and fourth quarter. So with those eligible wages, how do you calculate this credit? You're allowed up to $10,000 per employee during your open window. So it's not a per quarter in 2020, it's for your open window period within 2020. So if somebody hits $10,000 in quarter two, in the previous example, no more of the wages that they're paid would count. But if somebody made $4,000, $4,000, and $4,000, that's okay. You could use $4,000, $4,000, and $2,000, have $10,000 in total for this employee. The credit is 50%, so that's $5,000 per employee. For 2021, here's how the rules change. You don't need a 50% reduction. You only need a 20% reduction. So in our previous example, using $400,000 of revenue in a quarter, anything underneath $320,000 would qualify you. It would open up your window in 2021. Now it's the middle of the first quarter. We don't really know what your receipts are going to be for this entire quarter, but you might want to stop making some of your payroll tax deposits and use the credit to help you with those taxes that are due. For this, there's a safe harbor that says you can look at the fourth quarter of 2020 compared to the fourth quarter of 2019. And if you have a 20% reduction, you can use that to say that you're eligible in the first quarter of 2021. This is a way to increase current cash flow by not making the payroll tax deposits. In addition to these different rules for calculating the credit, there's a distinction between a large employer and a small employer. In 2020, a large employer was somebody with more than 100 full-time employees in 2019. And again, we have this employee concept with, again, a different definition. This definition uses the Affordable Care Act rules, which counts a person once they work 30 hours in a week or 130 hours in a month. And again, you look at your average for 2019 across all those months, and are you 100 or under in 2020? If you are, you're a small employer. That means all the wages that you paid count. If you're over 100 employees, only the wages count that you paid to people to not work. So if you sent your crews home for 2 weeks because everything was shut down, but you continued to pay them, and you're over 100 employees, those wages would count. But if you're like Markham and we got sent home, but we could all work from home, we're not working. So like our wages wouldn't count. That's kind of a distinction that you can draw. Another rule change for 2021, this 100 number changed to 500. And it's still for 2019. So if you were over in 2020, but you're under in 2021, you might now be eligible in 2021 because you're under 500 employees and you only need a 20% decrease. The best part about the rule change in 2021 is that credit changed from $10,000 for a calendar year to $10,000 per quarter of eligible wages, and the credit went from 50% to 70%. So instead of a $5,000 maximum credit in 2020, you can have up to a $14,000 maximum credit in 2021. Why does this matter now? Because the legislation on the 27th said that if you had a PPP loan, you can also have an employee retention credit. Up until the December 27th, it was one or the other. And for almost everybody who qualified, the PPP was a better option because it's 100% free money. And in 2020, it was only 50% free money, capped at 10,000 of wages. We got guidance that health plan costs can be included in ERC wages. That's really good if you furloughed someone, but you were still paying their healthcare costs. Even though they had no wages, their healthcare costs can count for the ERC. And if you weren't paying them wages, they're probably not in your PPP money. So that might be a way to have some costs eligible for ERC. And this last bullet here says that the way that you actually get the credit right now is you have to file amended 941s for 2020. Now here's my thought on this. The IRS is about 6 months behind in opening their mail. I don't know when you might get your money if you amended a 941. The law instructed the IRS to provide guidance on how to apply for this credit. So we're hopeful that they might issue an expedited way to claim this credit, maybe through faxing the 941s like they did with the NOL carrybacks with the Payroll Flexibility Act in June. So if I have an option now of waiting potentially 9 months to get my money by amending a 941 or waiting a few more weeks just in case the IRS has an expedited process, I'm going to be more apt to wait a couple more weeks, figure out my math, and see if the IRS has given me a faster way to get these refunds. All right, here's our example. This is my favorite part. So we're going to assume that this company qualifies for ERC and for PPP. So their payroll loan was $600,000. Over the course of 24 weeks, they spent $1.2 million of payroll. They have 50 employees. They also spent $100,000 on rent and utilities, et cetera. So how much is the maximum ERC, and can I still get full PPP forgiveness? So we need $600,000 of costs for our forgiveness because that's our loan amount. If we don't have any full-time equivalent reductions, that's great because now we don't have to worry about having extra costs on our PPP application to cover the eligible expense reductions. Since we have 100,000 of non-payroll, which is well under our 40%, we really only need $500,000 of wages out of that 1.2 million. That leaves us $700,000 available. We only have 50 employees. The maximum that I can use for wages for any one is $10,000. 50 employees times $10,000 is $500,000 of maximum eligible wages for the ERC. Number one, that could give me a $250,000 credit on the ERC, right? $500,000 of wages times 50% credit gives me $250,000. That's awesome. Two, it still leaves me $200,000 of extra wages that I can put on my PPP application if I need it to absorb an FTE reduction. You can see the math in this last bullet point. If I have $800,000 of total eligible costs, which is my $500,000 of wages from bullet 3, my $100,000 of non-payroll from bullet 2, and my extra $200,000 from what looks like the 7th bullet, I have $800,000 of total eligible costs I can stick on my PPP application. If I lost a quarter of my employees compared to my reference periods, I lose $200,000 of those eligible costs. That still leaves me with $600,000 of cost on my PPP application, which is the same amount as my loan. So this is an example of how you can take all the wages that you paid, your non-payroll costs, and put them all together to see if you maximize your ERC and full PPP forgiveness. And in this case, get a $600,000 loan forgiven and $250,000 of ERC, $850,000 of benefits on $1.2 million of wages. Not bad. All right, I'm done talking. A little bit out of breath from going through that pretty fast with you. Looking forward to the FAQs. I'm going to turn it over to Jeff, who's going to go over how CMIC can help capture the data you need for both of these.
Great, thank you, Mike. So we're going to go through a very, very quick overview in terms of the number of data points that can be captured and reported on, whether it's in a report specifically that is hard-coded, or even better, in a dashboard, which then can be filtered, pivoted, and manipulated in order to get the data that is required. As Mike mentioned, there's so many different permutations that you can track and examine whether you're eligible or for one of the programs, and if you have enough money in one of the buckets, apply it to a different based on different criteria set. So the number of data points that we just simply try to assemble, and the idea here is to not completely cover every single data point, but to know that a system that can track the number of employee headcount, for example, based on average monthly payroll and using multipliers to calculate what is the potential loan amount, to track at any point in time all the gross receipts, either by month, by quarter, by year, and to manipulate what the quarter is. Quarter could be calendar year, fiscal year, etc. Compare all the expenses from 1 year, 2019 to 2020, to see where the reduction might occur so that you could qualify and apply for the loan forgiveness. And not only see the summary detail, but also be able to take a look at the detail if you need to examine the specific receipts and go into every single transaction allocated to every single particular general ledger account or allocation that is necessary, whether it be a GL account or a company that is set aside specifically to track these transactions. Now, not only are we talking about payroll expenses, but we also are talking about non-payroll expenses. So other expenses that could enable eligibility for the loan forgiveness, which includes overhead and non-labor direct costs. Just to give you an example of some of the dashboards and some of the capabilities that a system that is comprehensive can offer. Next slide, please. Next slide, please. So we have, just as a slight illustration, a number of components and widgets that can be brought together on a single console or on multiple different pages as necessary. The idea here, even though this is a static image, the idea here is that the user can manipulate the view of the data, but just know that the data is accumulated at source and is available at the most integral level. So the top widgets could just talk about FTE by company. This is just a visualization. Or you want to see by employee, by trade, employee count, and activity amounts for payroll transactions, whether they are eligible within the $2 million loan limit. Next slide, please. This illustration is just a depiction of gross receipts and all kinds of receipts, with gross receipts across the company, and summarized by period. You can also summarize this by quarter and bring it into the calculation that is necessary for you to get these numbers in. Mike mentioned many, many different types of categories and numbers that could be used for your application. And in order to understand where these numbers come from, you need to be able to track these transactions and then summarize them in monthly or quarterly buckets. The depiction below the summary is if you drill on any one of these hyperlinks, if you will, or any of these numbers, you'll be able to actually see the specific transactions that make up the summary calculation, the summary of all those transactions into a single period in this case. Next slide, please. And lastly, for non-payroll receipts, and so you have an expenses as well. You can allocate. You can pick any number of GL accounts or categories that have been allocated, whether the receipts are posted to specific, and you can have unlimited types of allocations that is necessary, and you can then group them into the same kind of periodic buckets, whether it be quarterly or yearly, and in order to get to the number that you require to put on the application for forgiveness or for the loan. And this is just an illustration of the kind of data that is tracked, but there's many, many more data points that are available using a comprehensive enterprise system in order to utilize for this kind of facility, whether it be payroll and financial, and of course, if there's an allocation to project costing as well, this is all available directly out of the system using the CMIC Analytics tool. At this point, I think we could conclude with the CMIC portion of what kind of data points are available out of an enterprise system, and we can go into the Q&A portion.
Thank you, Jeff, and thanks, Mike and Jeff, for your thought leadership. Truly appreciated. Just before we start, I believe it was the Wall Street Journal I read in this morning that construction is second in the use of PPP funds after restaurants and hotel. And Markham has the third largest practice for construction contractors, and I can tell you it's been a very big help for the industry. We have a lot of questions, so I'm going to jump right in and fire away. Mike, Max, I'm going to try to pick who I think's best for who. The first one's for you. Tell me more about supplier costs. Is this cost of goods sold, ? Oil contracts before PPP, paid for during the covered period, furnaces per install/repair?
So the question's quite common, and the answer is I don't really know, and neither does anyone else, because the guidance just says a cost that's essential to your business where you entered into a contract before you received your PPP loan funds and you paid for it after you received your PPP loan funds, except for perishable goods, which you can enter into contracts after you receive your PPP funds. It's the one that I'm hopeful to get future guidance on to narrow it down, because as the questioner asks, it's super broad. And I don't really know how to narrow it down, because what's essential to one business is in the eye of the beholder. So all those costs that were mentioned sound essential. They sound like something that right now, not knowing the answer, I would start to track.
Thank you, Mike. Next question is for Jim Miller, a very common question we get from a lot of clients. If you expect to have the loan forgiven, do you need to include it in income for 2020 if you don't get forgiveness until 2021?
Great question, Joe. And you're right, we do get this a lot. The treatment for financial statement purposes with respect to the PPP loan forgiveness can be treated in two separate ways. First is if the company and management determines that the guidance that they're relying on, consistent with GAAP, is long-term debt accounting, meaning they're treating the PPP as a long-term debt instrument, which GAAP currently provides guidance on for treatment of long-term debt. The forgiveness, or better said, treatment of the PPP in other income, occurs when there's legal forgiveness of the loan, legal release, which occurs at the time that the SBA releases that letter saying that you're free and clear of the liability. So from using that example, when you have a loan as of December that gets forgiven in 21, December 20 that gets forgiven in 21, it would be treated as long-term debt consistent with long-term debt guidance and forgiven in 21 and reflected in income. The second method that a lot of companies are talking about and adopting, if you will, for lack of better terms, is treating the PPP loan as a government grant, or for better terms, a forgivable government loan, whereby there is no specific legal release document. It's rather reasonable assurance that the conditions as part of the grant or forgivable government loan have been met, at which time the expenses for which the proceeds for the grant are used to fund have been expensed through the P&L, then the company can treat the PPP loan as other income. This is only practical because first of all, it's an IAS 20 rule, which is international accounting standard, and it's allowable because GAAP does not provide for private companies that are for profit to receive government financial assistance or government grants. So there's currently no GAAP accounting, generally accepted accounting principle accounting for US and FASB specific to those type of treatments, which GAAP then allows you to adopt other authoritative guidance, which allows you to adopt and use the IAS 20 model. So there's two separate ways to treat it. One, in summary, long-term debt, which it's treated in other income or classified as other income at the time of legal release or forgiveness. And then two is under the IAS 20 model, which provided that you meet the conditions of the grant, you spent the money on allowable funds, payroll costs, everything that's in those allowable costs over the covered period, then regardless of whether a company formally submits for forgiveness or has it forgiven by the end of the year, the IAS 20 model allows for treatment in other income on the company's financial statement.
Thank you, Jim. And Jeff, it looks like this one's right up your alley. Since the SBA has authorized lenders to determine applicants' eligibility for loan forgiveness, what will be the essential to achieve a smooth loan forgiveness application?
Well, it's always a difficult question because the Small Business Administration has always authorized lenders to determine the applicant's eligibility for loan forgiveness. But given the lack of guidance by the SBA, it may be difficult to ascertain how detailed each lender will be when determining loan forgiveness eligibility. So it will be crucial to maintain a detailed ledger and documentation of PPP loan expenditures to support the proper use. And this will help prepare your company for a smooth loan forgiveness application. Suggest that the support documentation includes payroll registers, health insurance invoices, retirement benefit contribution calculations, lease agreements, utility invoices, and mortgage statements as applicable. And once your company's window opens to apply for loan forgiveness, you don't want to be delayed in submitting the request because you can't find the proper documentation. Another important consideration is that the program clearly outlines that at least 75% of the forgivable proportion must be spent on qualifying payroll costs. It would therefore be probably valuable to have an additional tracking mechanism to differentiate between payroll and non-payroll expenditures. And this could be accomplished in several ways, including new general ledger accounts or a new company within your enterprise system in order to track that uniquely. So that would be the way to proceed.
Thank you, Jeff. Mike, next one's for you. Employee count and revenue decline under definition of affiliate or affiliated businesses. Treatment of affiliates under PPP, R3.
Okay, so affiliates under PPP are super not fun because they don't follow tax and they don't follow GAAP. They follow their own set of rules, which is loosely based on both, but the worst parts of both, which means basically you kind of have to count everybody. And affiliates are ownership. So if you have greater than 50% common ownership, that's affiliated. That's probably the easiest route. The one that catches a lot of companies is the management affiliation. If you have a common C-suite, a common manager, regardless of ownership, that counts as an affiliation. So Joe, if you happen to be the CEO of 4 different companies and you don't own any of them, those 4 companies are affiliated because you have common control over the management. And one of the ways that you can figure out if you have common control among management is, does somebody have the ability to veto a corporate action that's not the sale of the company? Because almost anybody could do that, and that's okay. So if you want to veto a corporate action and you can, that would give you like an affiliation among management. So you really have to dive into some of the operating agreements if you have that type of common management scenario to see if you have an affiliation on that. And it's really a facts and circumstances versus a bright line test. And when we run into that with clients, we've often grabbed the legal counsel too and said, hey, let's go interpret this together and make sure everybody's on the same page, because the rules aren't clear. It's all facts and circumstances. No matter what we decide, there's going to be risk. And is the company comfortable with that risk to move forward? And then documenting it, just in case 4 years down the road, the SBA comes in and goes, hey, we think that you're affiliated. We go, we don't really think so, and here's why. You can at least get out of any penalties because you've documented what you thought. Even if the SBA disagrees, the only penalty might be repaying the loan. But if you've documented it and you can prove your case, maybe the SBA goes along with you.
Thank you, Mike. Jim, next question. If we meet the test for decline in gross receipts on an affiliate basis, can we apply for second round PPP loans on all companies? We have 6 affiliates, 3 of which meet the criteria individually. Can the other 3 also apply since we met the test on the affiliate level?
That's another great question, Joe. We get this a lot. So the 25% test, the revenue gross receipts test, is measured on an aggregate basis with all the affiliates. So meeting all the criteria that Mike just went over as to what the definition of an affiliate is. In this example, there's 6 companies, 6 affiliates. The 25% test is done on an aggregate basis. Provided on an aggregate basis, the affiliated group meets the 25% test. Each affiliate within the group separately is allowed to apply, eligible to apply under the SBA current guidance. Again, provided that they have separate EIN numbers and consistent with the first round where you would apply individually. The 25% test is done on an aggregate basis to answer the question, and all affiliates within the affiliate group, provided that the aggregate calculation for gross receipts, there is a 25% reduction on a combined basis, that each affiliate is eligible to apply.
Thank you, Jim. And Jeff, the next one's for you. What specific reports are important for me to track and maintain?
Well, the classic ones are taking the data points and the metrics that have been discussed throughout the discussion today. Total employee headcount for full-time employees, that's one. The potential loan amount based on payroll expenditures. Another report that could be very interesting is the analysis of gross receipts and segment them by month, quarter, year, things like that. To be able to compare year on year the 2019 to 2020 on terms of potential reduction of gross receipts. That is obviously very, very critical. The ability to drill into details down to the transaction level. It's always good to see where the transactions come from in order to support the actual summary by allocation. And of course, not only payroll costs, but non-payroll expenses to understand the eligibility for loan forgiveness and non-labor direct costs. Those are all some of the metrics, not necessarily comprehensive, but those are some of the basic reports that one would require in order to get out of the system in order to facilitate the application and the ongoing eligibility.
Thank you. Mike Max, next one's up for you. Is when applying on April 3rd, 2020, employee tips weren't in the definition of payroll and weren't part of our application. We hope to be able to go back and get an increase. What's your experience in that area, Mike?
So the definition of wages for the PPP references the area that defines it to include tips. So the PPP guidance doesn't specifically say, yes, include tips, but where it references what wages count, that definition includes tips. So if you didn't include tips the first time and you want to go back and get PPP1 to include it, I would say that you can. You contact your bank, go through the PPP1 additional draw application, which is on the Treasury and SBA website. If you wanted to look at it before applying, almost every bank has an online portal, so you have to use their version of the form, but it's always helpful to know what they're going to ask you about. My one kind of caution would be, before you apply for PPP2, you have to spend all your PPP1 money. and an additional PPP1 draw, in this case, would count as PPP1 money. So you'd have to get it and spend it before March 31st before you could apply for PPP2. Given we have 6 weeks left, and I don't know if you could spend all that money in the extra time, maybe look at which loan's bigger if you can qualify for PPP2. You know, if you get more by applying for PPP2 and including your tips from 2019 versus just getting the extra, I'd probably go that route just out of practicality purposes.
Interesting. Thank you. Jim Miller, if our business started in December of 2019, what data do we use to show our revenue decline? i.e., how is this measured?
Sure. So the revenue decline test, the business was incorporated prior to February 15th, 2020. Therefore, the measurement in this case for the decline, you would take Q1 of 20 and compare it to any other Q2, 3, or 4 as part of 20, and provided that there is a 25% reduction test or a reduction over that measurement, that's how you would measure it for a business that doesn't have a full quarter in 2019 to compare it to, but is incorporated prior to February 15th, 2020.
Thank you, Jim. And I'm going to go back to Mike Max on this one. The ERTC is an actual credit, or is it a tax deferral?
It's an actual payroll tax credit. So not an income tax. It doesn't go on your 1120, 1065. It goes on your payroll tax return, and it reduces the amount of payroll tax deposits that a company is required to make for their employees, federal withholding, FICA, the company match on FICA. And if your credit's more than what you have to pay, you could have the rest refunded.
Thank you. Jeff, you're up next. I am tracking PPP and ERC information outside of my accounting system, paren, in Excel. Is this not advised? What are the best practices in this area?
Well, if you want to make a lot of errors and have a double entry and have redundant data silos, sure, use Excel. So is it advised? In an answer, in a word, no. We would recommend that you track all your transactions from source and not replicate them in any other system, another silo of data that is not necessarily verified. So in order to ensure the veracity of your data, you enter it once, you capture it at source, you have it available to you to analyze, to slice and dice in the way that you need in order to get the numbers that you seek to utilize for your applications, and use a system to that so that there's validity to all the data points that you're accumulating. If you're using an Excel, you can change numbers without any audit and without any veracity to the numbers.
Thank you. Mike Max, and your first ERTC slide, does it say that ERC in 2020 is limited to 5,000 per year, not per quarter? So there seems to be some confusion here between the 5,000 per year versus per quarter.
In short, yes. So for 2020, you're limited to $10,000 of wages for all of 2020 for one employee. So a 50% credit is $5,000 maximum for 2020. In 2021, the credit goes to 70%, and it's on 10,000 of wages per quarter. The credit's only around the first 2 quarters of 21, so you could get 14,000 for one employee in 2021 versus 5,000 for an employee in 2020.
And a follow-up on that for the ERTC, if there's a government mandated shutdown, do we automatically qualify without looking into revenue declines?
Yes, I would recommend that you get that government order, look at the specific dates that are on it, and the wages eligible are during the dates of that government order.
Thank you, Mike. Jim, has there been a determination if the $2 million safe harbor threshold is looked at with respect to each individual loan or the sum of rounds 1 and 2 combined? In other words, if round 1 and round 2 loans are 1.1 million each, are you within the safe harbor because each loan is less than 2 million? Or is that considered in excess of 2 million?
That's a great question. I haven't seen anything issued with any sort of certainty as to what that is, but the interpretation is, that 2 million threshold is when you take PPP1, PPP2, combine it, and that would bring whatever, if it is in excess of 2 million, that might bring you outside of that safe harbor, might make you subject to the necessity questionnaire and other items. There hasn't, to my knowledge, been any specific guidance addressing that part of it, but that's kind of been interpreted across the industry and talking with many attorneys and other practitioners across the country that help interpret the legal language within the law. And I think, there's obviously going to be further interpretation of that, but, heading into that, I would plan accordingly. Just best practice, I think, even if you're under that 2 million safe harbor, we've seen in many cases, people under that 2 million get selected for audit. Best practice is to just have that necessity questionnaire completed, because once if you are lucky enough to get selected for audit, or if you do go for PPP2 and are above the 2 million on an aggregate basis, and you are required to, or requested to submit that necessity questionnaire, there's a 10-day window, and just kind of, the more ready you are, the more prepared you are, the more you can respond and ease that process. So just a little best practice there.
Thank you, Jim. And Mike, I'm just going to go back to your comment on your affiliate rules. Do they apply to the ERC? There's several questions here, so I'm just summarizing several of them.
Sure, there are affiliation rules with ERC. Of course, they're entirely different than PPP. They fall under the multi-employer retirement plan rules, which can get a little complex. In short, there's, I think, 3 ways. One is common ownership, like brother-sister companies that are more than 50% owned by related individuals. So you have to look at like husband, wife, father, son, mother, daughter would count as like one person. So if mom and daughter each owned 33% and an unrelated person owned the other 33, mom and daughter combined affiliate own more than 50%. So anything else they own 50% of would get wrapped into the ERC rules. There's parent subsidiary. So if a company owns more than 50% of another company, there's that roll up too for affiliate rules. And then there's another rule of, if you have a common relationship, but it doesn't fit one of those two, but you get a significant portion of revenue from that common relationship, that could also give you an affiliation. That rule is really complex. I was just working through it with a different client, with one of our national tax experts, to make sure that we understood all of the nuances of it, because it's extremely client situation specific. So if that happens to be something that you are dealing with and you're on the cusp of qualifying for ERTC, I would encourage you to dive into those rules as deep as you need to make sure you qualify.
And Mike, just to follow up, I have several questions related to how do you claim the ERC if you use a PEO? There's probably 3 questions that are asking that same question.
So the good news there is there's specific IRS guidance on their website on what to do with a PEO. In short, your share of the wages that you use for employees, you act as if you're their employer, because the primary reason of using the PEO is payroll and convenience, HR benefits convenience, access to different benefits. So you're not punished just because you made that business decision to use a PEO, where you have to include all of those folks. And as long as you're reporting from your PEO can break out who your folks are, that should be sufficient. But there is more guidance on the IRS website specific to that for those who ask the question. To get there, I just Google IRS FAQ ERTC, and it's the first thing that pops up.
Thank you, Mike. Jeff, next question's for you. I know you've spent a lot of time, CMIC, working on best practices to track this information for an easy tracking. But what is the best method to track the funds in your financial system?
Well, great question, Joe. Thank you. Well, every company is different, and every general ledger is different. Some will find it beneficial to create a new general ledger cash account to track the funds. Others will be able to track the expenditures using an existing structure. However, in some way, segregating the funds from the start will definitely assist in providing a concise register to cover the the costs. While there's no requirement to segregate the funds in a different bank account specifically, commingling the loan proceeds with other funds may prove difficult in tracking and documenting the qualified usage. So I would consider and suggest opening a new bank account or creating a new general ledger cash account as an additional layer of segregation, and the ability to do that specifically for this effort is readily, easily done, with the capable system.
Makes sense. Makes sense, Jeff. Thank you. Mike, does the 2021 ERTC also allow you to get credit for pay to employees working too?
Yes, if you're underneath the large employer rule. So for 2021, large employers, 500 or fewer employees, full-time employees using the ACA definition in 2019. So we know that data, it can't change. So as long as you're under 500 employees in 2019 using that ACA definition of a full-time employee, all of the wages that you pay are eligible for the ERTC. If you're over 500, only the wages you pay for people to not work count.
And a follow-up for you, Mike, if you did not qualify for ERC in 19 because you never had a 50% decrease in revenue, can you still qualify in 2021?
Yes, in short, you can look at each quarter separately. So if you don't qualify in 2Q of 20, 3Q of 20, 4Q and 20, and then in 1Q of 21 you qualify, that's when your window opens. So look at each quarterly window separately for the different revenue reductions. It would actually be possible to qualify in the second quarter, have your window shut in the third quarter, re-qualify in the fourth quarter, and then not qualify in the first quarter, and then qualify in the second quarter of 2021. So each one's separate.
Thank you, Mike. And for those asking, I see a lot of questions here. This presentation will be sent out along with the recording to everyone on the call. So if you missed something, we'll send that out. And obviously we have a ton of questions. I have 3 minutes left for questions before we stop. Any questions we did not answer, we will individually answer for you. So please don't worry about that. Jim Miller, what is the FTE reference period and average wage reference period for the second round of PPP loans?
Yeah, the reference period is very similar to the first one, where the calculations for the applicable periods are going to be for periods pre-COVID compared to maintaining those level of requirements. Mike, I don't know if you've seen anything published on specific dates. I haven't seen that.
What I've seen so far is that forgiveness for round 2 is going to be based largely on round 1. They did say that they'll issue more guidance. I think the way the SBA is looking at it is they've still got 20 weeks before anybody has to really worry about it.
That's kind of what I've seen. That's what I've seen too.
But you're right, Jim. The reference periods haven't changed. They're the same dates in 19 or 20 that you look back on as the thresholds to get over during your 2021 covered period.
Thank you, Jim. Thank you, Mike. And Mike, isn't the first PPP totally tax-free per the latest guidance signed in December?
Yes, both are completely tax-free for federal purposes, which I say it that way because different states are taking different stances on both the loan forgiveness and the expenses used for it. But federally, there's also no weird reductions of tax attributes that normally come with tax exempt income. It's just like tax exempt municipal interest would fall through as not taxable on a federal income tax return. It increases basis once it's tax exempt if you're a pass-through entity. And it's the same for PPP2.
Final question for Jim Miller. Company 1 did receive PPP1. Combined sales of both companies did not reduce by 25%. However, both companies file separate tax returns. How do you handle that?
So it goes back to the affiliation rules. If both companies meet the affiliation rules, then the combined 25% test has to be measured on an affiliate basis, aggregate basis. So even though they both file separate tax returns, if they meet the affiliation rules, they have to do the 25% test on a combined basis, and then they would file separately for the PPP loans. So going back to the initial example, where on a combined basis, the 6 affiliates rolled up and met the 25% reduction test, even though 3 of them did and 3 of them didn't. Though all 6 of those would be able to file. In this case, it would be the opposite. If in fact both companies combined on an aggregate basis didn't meet the 25% test, then neither company would be able to apply.
Thank you, Jim. This concludes our session. Mike, Jim, and Jeff, thank you so much for your expertise and thought leadership. CMIC, thank you for the opportunity to present together. Everybody have a great day. And as promised, we will follow up with all unanswered questions. Thank you for attending. Bye-bye.